You're listening to All Things Real Estate on Full Service Radio, 830 WCRN. Once again, here's your hosts, Gary Kelly and Brad Aubergon.
Welcome back to the second half of All Things Real Estate here on WCRN. I'm Gary Kelly, joined by Brad Aubergon, and we were talking about compact discs in the music industry. Actually, we were talking about closing disclosures. One of the things that we wanted to do for this show, Brad, and we failed miserably, is to get a financial advisor to come on, because one of the things I see financial advisors doing, and they don't want to be on the radio talking about it because of compliance issues. So we're going to have to talk as naive people. But what I hear them doing is saying, listen, you've got $500,000 in your account. Why don't you go buy a property somewhere, take a mortgage on it? You know, you'll have the property, you'll have the asset, you can enjoy it, but then I can reinvest those funds at a better rate, and this was a good financial move for you. Do you want to talk about that?
Yeah, I think that that's a great idea, in the sense that if you park all your money, or if you park a good chunk of your money in cash into a piece of real estate, it doesn't make it worth any more when you go to sell that real estate down the road. Appreciation is appreciation. Versus if you could have that money working for you in the marketplace, that's a good thing. And plus, it's being professionally managed, hopefully, and diversified, and all of those important, financial planning practices that are hopefully being put into place. But real estate should be a good part of your investment strategy. And again, looking at cash flow, whether you're buying an investment property or looking at your personal cash flow, if you're buying a place to live. These are all important factors that come into play, and making those things balance out is key. And that's where you astutely brought up, working with a financial planner is a very important part of that financial success plan.
A number of people come to me and they say that they're in a position of having cash because they've worked really, really hard and they've paid off their mortgage and they don't have a mortgage, and they're very proud of that. How do you reconcile having no mortgage and the security that comes with that versus being leveraged and having funds invested, but in different ways?
I think it's a matter of balance, and I think part of it goes into where people are in their lives. So, for example, if you have somebody that's retired and that's how they've accumulated all that cash, their cash flow is going to be is likely to be less than it was when they were working. And so it's important to have that quality of life balance, but also to maintain liquidity. A lot of people, as you said, are very proud of the fact that they have no mortgage, and that's a wonderful thing to achieve. But if you've done that at the cost of using up your liquidity, so that, for example, when the house needs to have some work done, or you want to go on vacation to see your grandkids, or whatever it is that you want to do to live your lifestyle, or more importantly, maybe to pay for food or medicine, whatever it is, you need to have that financial balance. And I think sometimes people get caught up in that. I don't want to have a mortgage. And then what they find is they either live longer than they had planned, or something comes up and they don't have those funds to be able to fall back on. So what I tell folks is liquidity is king. Liquidity is the most important thing. You've got to make sure that you've got a balance of your assets so that you can always be able to write a check should you need to. If you have your assets locked up in your home, that's not a good thing. You need to find that balance. And it's not to say that you leverage the home to the hilt to the point that you're going to have a problem, but it's a balance between the two. And that's where I come in and I work with folks to try to achieve that, and or financial planners can also recommend that.
One of the things that I want to mention is that when I went into real estate, I bought some property. This was in a 2008 timeframe, and if the loan officer held a mirror up to my nose and it fogged up, I was able to get a loan. Some of our listeners may have gotten mortgages back in that time frame where the hurdles were, I'm going to say, a little lower. Okay. And now the hurdles, I like to say it's a game, and you've got to make believe that the the mortgage company doesn't want to give you the loan, and that you're going to win the game by responding on everything. And it's really not a game. It's that as I understand it, it's that the mortgage company or the bank, they want to, not have risky loans and reduce their risk and not go through the same turmoil that we had during the Great Recession when all these, mortgages fell apart. Anything that you would say to someone looking to get a mortgage in insofar as the hurdles that it takes today versus 2008, and just using that as a target time frame?
Yeah, absolutely, Gary. So first of all, I was doing mortgages back in 2008, and I understand what was going on. And quite frankly, I steered clear a lot of those what would be called subprime loans, no income, no doc, no anything loans. And the reason is because they didn't make sense. I think the question one must ask themselves is, would I lend money to these people, right? Does it make sense to lend this money? And some of the things that changed is, number one, people that do what I do became licensed after that. You had a lot of people just kind of doing this business they shouldn't be. The other thing is that what we look at, it became more critical, meaning, we have to look at income, assets, credit. We have to look at those things because we as lenders don't want to put people in precarious positions where we have to foreclose on a property. Nobody wants to foreclose on a property. Nobody wants to put anybody out of their home. So what I tell folks is say, look, expect that you're going to need to document your income and your assets and your liabilities and show that you are creditworthy and that this is not going to swamp you. This is going to be we have to do what's called qualified mortgages, QMs, qualified mortgages, which means we're doing due diligence to make sure that this is going to be a good situation. The second thing that's more recently is with COVID, not the lenders specifically, but Fannie Mae, Freddie Mac, the people that set the rules for these things, have changed the guidelines because a lot of folks that were self-employed, they took a bad hit and their businesses took a bad hit. And so what they've done is they've increased the amount of documentation and scrutiny that's required, specifically a year-to-date profit and loss. So you have to show that the company, number one, got through COVID and did okay. And number two, coming out of COVID, they've been able to maintain their cash flow. They've been able to be successful. Again, looking at the long-term success, because a lot of companies fell into trouble during COVID, and subsequently some of those loans got into trouble. They took forbearance or otherwise.
So Brad, help me if I'm 70 and I'm not. And I'm interested in exploring some of these financial opportunities. Am I excluded because I don't have income in a traditional sense because I retired 5 years ago?
That's a great question, Gary. And the answer is no. So there's a couple of things that we look at. First of all, we cannot, all lenders, this goes for all lenders, cannot discriminate based on race, age, creed, or sex. And so if you're 70 years old, I have a running joke with my clients. I say, listen, I'll write you a 30-year fixed mortgage all day long, which means you're guaranteed to live to 100 because the bank's not going to let you die. The reality is that we look at cash flow. And so if somebody's 70 years old, the first thing I'm going to look at is their Social Security income if they receive it, as well as any pension income. The second thing that I'm going to look at, because of their retirement age, is their ability to draw down from their retirement assets. And I can, in a sense, amortize those assets over time and use them as income, at least from an underwriting standpoint, to offset any debt that they may have. That allows them to get a mortgage rather than have to pay cash if they're buying a property.
What about doing a home equity line if I want to tap into the equity of my house and not, is that easier? And I'll put quotes around that.
It's not necessarily easier. It's pretty much the same type of documentation. And again, most equity lines go to about 80%. The danger that I find with equity lines, and it depends on the situation. If you say, Brad, listen, I need 30 grand to spruce up my house. I'm not worried about you. I'm going to send you to an equity line all day long because it's no points, it's no closing costs. And if you had to, I'm going to look at your assets and say, if you had to pay it down to zero or cut it in half, you could do that. If somebody comes to me and says, well, Brad, I'm taking $130,000 out because I want to build an addition onto my home or I want to buy a second home somewhere, That's different because equity lines typically have floating rates of interest, variable rates of interest that can change month to month and are often tied to prime. So as prime goes up, as the economy picks up steam again, those rates are going to rise. The pro side of an equity line is not only are they no points, no closing costs, but they're interest-only payments. So it keeps the payment nice and low for the first 10 years. After that, it amortizes out, which if you're on a retirement income and you haven't paid that back down to zero at the end of 10 years, that could be very, very dangerous for you. So you have to, it's all part of this integrated plan. What are you going to do with the money? How long are you going to need the money? If you're going to, fix up your house or sell your house down the road within 10 years, equity line's a great way to go. But if you're going to hang on to that and 10 years from now, you're going to have that $130,000 and you're on a retirement income, that can be a very, very difficult situation and one that I would not prescribe to. And I'd say, let's look at a 30-year fix.
If someone wants to reach out and have further discussions with you on this, how would they do that?
Best way to reach me, Gary, is via my cell phone. That's 978-375-5531 or via email at bavergon, that's BAVERGON at envisionbank.com. Gary, how do they reach you?
I'm Gary Kelly. I'm with Remax Executive Realty, and I can be reached at 508-733-6005 or Gary at movewithgary.com. Well, Brad, I have enjoyed this conversation. I hope you have too. I hope more importantly, I hope our listeners have. And I look forward to getting together with you again in about a month.
Sounds great, Gary. I look forward to it as well. Be well.
Thanks, now.
You've been listening to All Things Real Estate on Full Service Radio, 830 WCRN.